Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the Acca tutor, Mr. Jerry Mutumukulu, and I'm available on +263-774-596-368 or through email at transcarolex@gmail.com. In this video, I'm going to explain a few tips related to the Acca Advanced Audit and Assurance paper. Okay, they're just exam tips, and they are related to risk. Remember, in the Acca paper AAA, there are two forms of risks which are examined. We have got audit risk and business risk. Risk is usually tested on question 1. That's where we normally find risk requirements. So you need to enter into that exam hall knowledgeable of these two forms of risks. Now, let us start with audit risk. What is audit risk? Audit risk is the risk that an auditor issues or expresses an inappropriate opinion, okay, when the financial statements are materially misstated. So basically, when you're talking of audit risk, we are simply referring to the situation when the auditor issues an inappropriate audit opinion. Now, audit risk is a function of two things. Audit risk is a function of two things, namely Romm and detection risk. Romm stands for risk of material misstatements. Okay, now when you're talking of Romm, okay, let me just write it here. Audit risk is equal to Romm plus detection risk. Okay, don't worry about the use of multiplications and so forth. They in actual fact, this is not like an equation, okay, but we are trying to let you know what will be happening, because there is no way you're going to be required to solve Romm subject to the formula and so forth. You're not going to be required to do that, but we want you to understand that when you're talking of audit risk, we are simply referring to two things that are happening, or that have to occur, rather. Two things have to occur for us to say there was audit risk. Okay, so there should be some risk of material misstatement, and detection risk. Okay, so risk of material misstatement has got two risks included in it. We have got what is called inherent risk. and then control risk. We know this from our paper F8, okay, our paper AA. The audit risk was examined there, all right, and it is also examined in paper AAA. All right, what was not examined in paper AA was the business risk part of it. So when you're talking of inherent risk, we are simply referring to the risk which is prevalent due to the nature of the client's financial systems, okay, or the client's business operations. So it's risk that is just attached, or that is going to be present because of the way the client does his business, or because of the client manages the financial system of his business. Okay, for example, they've got a tendency of hiring inexperienced, less qualified accounting personnel. So in that case, we expect the risk of errors being prevalent in their financial statements. So that's an inherent risk. It is something that occurs because of the nature of their practices, their processes. Then when you are looking at control risk, we are simply referring to the robustness of their system. Okay, does their system allow a timely detection, okay, or a timely control, or a timely reaction to an error? How quick is it to identify an error, or how strong is it to prevent errors from occurring? So the control is actually linked to the internal control. How strong is it? What is the control environment? All right. And then when you're looking at inherent risk, this is the nature of the systems, not really systems, but the nature of the business, how they conduct their business. All right, so basically all these are linked to the client, their client specific risks. So something should be wrong within the client's system that might actually trigger the risk of material misstatement. However, having the risk of material misstatement alone is not going to create risk unless there is detection risk, because the client might be in error, but if the auditor's processes are going to detect those errors, then there was no audit risk, but there was only risk of material misstatement, but which that is not going on its own is not going to come to audit risk, because it has been reduced to zero. The audit risk has been reduced to zero because we have detected the error, so there was no audit risk. Okay, so detection risk is the risk that the auditor is not going to detect the error or the fraud in the financial statements. Okay, detection risk is the risk that the auditor's processes are not going to detect an error or fraud within the financial statement. So let me just write it: risk that auditor won't detect the errors in the financial statement. So we've got two forms of this detection risk. We've got sampling risk sampling risk and non-sampling risk. When you're talking of sampling risk, we are simply saying the sample which the auditor adopted or utilized in his audit procedures was not big enough, was not representative of the population, was not representative of what was happening at the client or within the client's records. Either the sample was too low or it wasn't representative, it wasn't enough, it wasn't large enough. Okay, that's the sampling risk part of it. But when you are talking of non-sampling risk, this is all other risks not related to sampling. For example, the auditors only sent juniors throughout. Juniors were sent throughout the audit, and the partner only came the last day to sign the audit report. Okay, so juniors were sent, lack of experience or skill. Sometimes you send people who are experienced in auditing, but they do not have the requisite skill to audit this particular client. So that's a non-sampling risk. Or there was time pressure. The management were insisting that they needed their audit report as quick as possible. All right? So the auditors ended up cutting corners. Or they had no resources. There were no resources to visit all the sites. No resources. All right? So all of these are auditors' part. They are auditors' error. Okay? Or the auditors succumbed to the bribe. Okay? They succumbed to the management's pressure to bribe them. So by the end of the day, that's a detection risk. All right? They were blinded. So by the end of the day, they ended up doing a shoddy audit, shoddy work. So this is what actually happens. So when we talk of these risks, all of these have to be present for audit risk to be there. All right? Now, tell me, let us say the auditors are inexperienced. They don't actually know what they are doing, okay? But the client's reporting is just perfect. No fraud, no errors. Can we say there is audit risk? Obviously, there's no audit risk. So you can see that both have to be present for audit risk to be there. Are we together? Both have to be present. To say that the audit risk was high or was low, that's actually what happens. We need to have both. It's either the client reported wrongly and the auditors did not see the error, then the audit risk was there. Okay? But when the client reported wrongly and the auditors detected it, then there was no audit risk. Or the auditor reported nicely and correctly and fairly, but the auditors came to their audit drunk and ended up producing a clean sheet audit report. There was no audit risk at all, even if they were drunk, because there wasn't anything wrong within the financial statements. All right, now coming back to the definition, the audit, definition of excuse me, the definition of audit risk. we are saying here, it is the risk that an auditor issues or expresses an inappropriate opinion when the financial statements are materially misstated. There is a lot of debate about this definition because sometimes the auditors might issue a wrong opinion when the financial statements were actually not materially misstated. For example, the client's financial reports were just clean without any errors. However, the auditors ended up issuing a qualified opinion, or they issued an adverse opinion. So you can see that the definition is actually conflicting with that situation. So it is actually safe to say audit risk is the risk that an auditor issues or expresses an inappropriate audit opinion. That is actually fair to me. All right, that is actually a fair definition because it is about issuing the audit report opinion. All right, but that is a meal of another day. Let us at least comply with the relevant ISAS definitions as well as the approved content definitions. Now let's move on to a more pedantic area, that is the issue of attacking exam questions. All right, how do you attempt an audit risk question in a AAA exam? Let's start with the Romm, the risk of material misstatements. Okay, remember the AAA exam is a bit advanced exam where we are expected to show some maturity, some professional judgment, some professional skepticism. All the levels of strategic thinking are required. So you need to actually exhibit those attributes of a professional, of an expert. All right, now the Romm. Usually when the exam requirement comes and say determine the risk of material misstatements within this scenario, you need to expect 3 marks for a point that has been raised. Okay, for a risk that has been identified, a maximum of 3 marks could be gained. Okay, so you need to lead yourself very much in a professional way. Now you need to first identify which financial statement item has been affected. Okay, which item has been affected? For example, is it a provision that has been affected? Okay, the balance of a provision has been affected. It could be under or over. Okay, understated or overstated, or misstated. But the question now is, when do we use terms like understated, overstated, or misstated? Now, this is where you need to show your maturity. Sometimes to say there is a danger that provisions could be, the provisions balance could be misstated. The word misstated is not telling us anything. You should only use that word when it is not clear. When it is not clear, when you are not given real figures about that provision or about that element of the financial statement or that item. If you're not given, okay, for example, the common engages in online trade, okay, there is actually a risk that revenue could be overstated or understated or misstated. All the words can actually fit if you are not given the revenue figures throughout the scenario. Okay? So there is a risk that they could, all the terms could fit. But when you are given the figures, then you need to play around and try to use, sometimes you're given the figures as well as what is actually happened. Okay, what is actually happened, and you should be able to make inferences that if these guys have recorded the revenue figure this way, there is a danger that the revenue figure is understated, as could be inferred from A, B, C, D. Okay? But sometimes you will discover that if the examiner was just general, okay, then there is you could be allowed to use misstated because it's not clear what was happening. So it's an issue of just generalizing. All right? Then it can also, be an issue of you need to show the examiners that you have identified that there was an error. So in that case, you need not to just say might. Terms like might or could be. These ones shows that you did not identify that anomaly. You are just vague. You don't want to come open. So in that case, you might not earn a mark. Okay, for example, you've actually seen that a provision that should have been recognized in the financial statement was not recognized, but instead a contingent liability was disclosed. And according to your understanding of IAS 37, you are convinced that it should have been recognized. Then in that case, you need to tell the examiner that they misstated something. Okay? They have misstated the financial statement because they did not recognize a provision when they were supposed to have done so. So in that case, be open to say that the financial statements are actually misstated because of this, and this issue is actually material if it is material, which means the financial statements have to be amended. So please, you have to determine which financial statement item is affected. Be in a position to single out that thing, and you can only do that by resting on your knowledge of strategic business reporting or financial reporting. All right? If you're not resting on those premises, then you're likely to fail. Now, let's go a little bit deeper. You need to explain the financial accounting or financial reporting rules. Or let us just say the International Accounting Standards or IFRS rules. This exam is not an exam of showing examiners that you know the accounting standards by their names and numbers. No, you need to tell us what those standards are saying about this particular item. It could be its measurement, subsequent measurement, or initial measurement. It could be the recognition criteria and so forth. Tell us what should be done. not wasting time writing the standard numbers. You actually don't have that time in an Acca Aaa exam. You don't have that time. So please be careful there. So you need to tell if it is about an intangible asset with an infinite life, if it is an intangible asset with a definite life, you need to be able to actually say what is required in terms of the respective International Accounting Standard or International Financial Reporting Standard. So say the rules. All right. Then you need also to say, to explain why you as an auditor feel that the client's accounting treatment is wrong. Why do you feel so? So after you say, like, for example, the first part is you need to explain the financial reporting rules. Okay, for example, inventory is valued at the lower of cost and NRV. All right, that's the rule. And then in terms of ABC Company's inventory recording approach, they have recognized inventory based on their fixed standard costs. All right, and the finance director feels that those costs are the appropriate costs. This is actually wrong because inventory should be valued at the lower of cost and NRV. So in that case, you have been brief enough and you have also shown that you have noticed something within the scenario. Remember, the risk of material misstatement is actually involving two things: the issue of the inherent risk and the issue of the control risk. Okay, so it is actually a risk of those balances, those account balances being wrong. Okay, oh,